We're going to round out our study of Chapter 6 with hitting self-employment tax, nanny tax, some other additional tax items. So, self-employment tax. For those who are employed by a company where they get their paycheck every week, every 2 weeks, or whatever, there is a line item, or there are two line items on that, I should say. One says Social Security and the other one says Medicare. And a portion of your paycheck comes out and goes to those places. Self-employed people don't get paychecks from themselves, so there is no employer to take that money. Plus, on your paycheck, what you see is only half of the Social Security and unemployment, excuse me, Medicare equation. The employer is actually paying another half of that. Well, again, when you're self-employed and there's no paycheck and no one's withholding that Social Security money from you as if you were an employee, and you are also the employer. So guess what? You get to pay both sides of that, the employer and the employee side, on Social Security as well as Medicare. And the percentage, for just the employee for Social Security is 6.2% and 1.45% for Medicare. Same thing on the employer side. So now as a self-employed, we double that, and it's 12.4% Social Security, 2.9% Medicare. And Medicare and Social Security are, or at least used to be collectively, known as FICA, because they are part of the Federal Insurance Contribution Act. And back when I was 16 and had my first job, that was only one line item. They had combined Social Security and Medicare together, and it would just show up as FICA. I don't even remember at what point that changed and those broke into two separate line items, but I digress. Anyway, so as the self-employed person, you are required to pay both sides of that. You do, however, get a deduction for AGI as a result of this, so it takes the sting off a little bit, and it will make more sense when you actually have to go through this calculation process in the homework to see how that self-employment tax fits in on the for AGI analysis. But yes, it does not take all of the sting out of it, that additional deduction. If you are a self-employed person and you do any work for somebody that is $400 or more, you have to report self-employment tax on that money and pay self-employment tax on that money. So yeah, you pick up a little side job for somebody, maybe you work for them for a couple of weekends. If it amounts to $401, guess what? That $401 you just made is subject to the 12.4% Social Security and Medicare self-employment tax. Yay. So, and as I mentioned, you can take there's a for AGI deduction to take the sting off of it a little bit, but this can be a huge chunk of money and quite often a place where self-employed people get in trouble really fast with the IRS, because unless they are setting this money aside as the earnings come in and that money is segregated and then paid to the government quarterly in the form of estimated tax payments, what often happens is that these folks do their taxes come April 15th, and they are completely shocked and blown away at how much that money added up to over the course of a year, and often they don't have it. They have not set it aside, and they end up in debt with the government. And often those folks had some idea that they were going to owe money. So do you think they prepared those tax returns Johnny on the spot in late January or early February when they could have? No, they've procrastinated. They filed an extension. They did everything possible to delay having to confront the inevitable of knowing how much, in fact, that they really owe. So if they, in fact, have filed that extension and are only just learning about this in October, they now owe a ton of money. Plus, they've probably continued the same bad habits from January through October of the following year. And so not only are they going to have a bill for the return they're preparing and about to file, but there's probably a big whopping tax debt from the first 3 quarters of the next tax year that they have not planned for as well. And it becomes a slippery slope, and often it ends with many, many years of unpaid taxes that have to somehow get resolved. So the moral of the story is, if you are self-employed, make sure that you are setting that money aside without fail every week, every month, every quarter, whatever is necessary to keep you on track, and make sure that that money gets paid in the form of estimated tax payments so that when you prepare your taxes, there's nothing due. Yay. Okay, so we're going to do a little example here with Wanda. She's self-employed as an accountant, and Wanda earned $108,000 and has wages subject to FICA from a part-time job of $7,200. And I guess the point I also did not touch on is that there is a cap to what, and I thought it was on one of these slides, but perhaps not. So 132,900 is the Social Security cap for 2019. And so regardless of how many jobs Wanda works, because Wanda's employers don't talk to one another, if Wanda's got multiple sources of income coming in, Employer A and Employer B have no idea what each is paying Wanda, so they don't know when that $132,900 cap gets hit. Now, if one of them pays her that amount of money, they will know and they'll stop withholding. But if these things are being done in isolation from one another, Wanda's going to ultimately have paid in more than she probably needed to, and she will then get that excess money back. So never fear, but never good to pay money you don't have to pay. So back to Wanda, the self-employed accountant, earning $108,000 from and has part-time wages of $7,200. How much is Wanda's total self-employment tax? Now, fortunately, Wanda is not going to meet the cap, so Wanda will not have paid more than she needed to. And so Wanda's got the 132,900 minus her FICA wages, and then 125,700, and I should say FICA wages, the wages that were withheld from her part-time, or the wages that she received from her part-time job that were subject to Social Security and Medicare withholding. And that leaves her with her self-employment base of 125,700. So now what we're going to do is we're going to take her wages from her part-time job and multiply that times 92.35. Well, where do we get that? And so what is left if we subtract 100% or subtract 92.35 from 100%, we get 7.65%, which is the 1/2 Social Security and Medicare. So we're going to multiply her wages after deducting for self-employment tax, and then that's what we're going to use to multiply the Social Security and Medicare percentage by. And I should add that there is no cap to the Medicare. That is paid on every dollar she earns, and it doesn't stop. We're moving on to something called the nanny tax, and despite its name, it doesn't just apply to nannies. It really applies to any household employee. And they get a little bit of a break here, perhaps, if it's really limited in nature. They don't have to pay, unlike self-employed people, it triggers after $400. For nannies, it's $2,100, or I should say household employees. It's $2,100. So if you've got the neighbor person down the street who comes and watches your child for you, unless and until you've paid that person $2,100 in a tax year, that money is free from Social Security. If, however, you hit that threshold of $21,100, the entire thing becomes subject to Social Security. Furthermore, once you've paid them at least $1,000, the household employer, not the employee, but the household employer has to pay FUTA, which is unemployment tax on a federal level. And that's usually pretty nominal, but that has a much lower threshold for being triggered than the Social Security does for household employees. Now, there are some exceptions to this, and there are classes of folks that won't be subject to the FICA. And so if your spouse, your parents, your children under 21 provide the service, or anybody under 18. So if the teenage neighbor is coming to watch your children and it's under 18, I should say, this will not apply to that unless they have a babysitting service, or perhaps they've decided to put a local day camp together or something like that. So that would be different. But your otherwise casual teenage babysitter won't fall within this, nor will your own, the siblings of, if you have siblings watching younger children, similarly, they will not be subject to this, nor will grandparents. And so if there are non-household workers, if you're self-employed and you've got people watching your kids, and then you've got that are going to be subject to the nanny tax, maybe you went to an agency and you got yourself a nanny and it's more than $2,100, and so you're going to have to report that and withhold and submit those withholdings to the government. You can use forms 941 and 940 along with all of your other non-household workers, your regular employees. You can put everybody together on the same quarterly payroll tax return. So the 941 is the return for the withholding of not only the Social Security and the Medicare, but the federal income tax withholding. The 940 is the annual form. So the 941 is quarterly, the 940 is annual, and that's the FUTA. That's where the unemployment gets reported. And then you also have to give those folks a W-2. And if that wasn't enough, wait, there's more. So for people who receive substantial income from investments annually, and as you can see on your slide, it's over $250,000 for joint filers, $125,000 married filing separately, $200,000 for single filers. They are tagged with an additional 3.8% of their investment income just for Medicare. So if they also happen to have other wages and that were already subject to the 1.45%, this is over and above that. So their investment income, interest, dividends, royalties, all of the things that you see listed here will be subject to an extra 3.8% Medicare tax. There are some exclusions from that. You don't pay it on the gain on the sale of principal residence. It is not paid on distributions from retirement plans or earned income. They'll get you on that in a second. Or tax exempt interest. And Now, just in case you were worried that high earners with jobs got left out of the extra Medicare, we'll call it a penalty, but it's not. Never fear. The government thought of them as well. So for the same income thresholds, the 250 or 150 and 125, depending on their filing status, they are going to pay an additional 0.9% Medicare tax. Yay. Now, if they are not self-employed, if they are working for someone else, this tax gets withheld from anybody's salary that is paid more than $200,000. So if it turns out that the combined husband and wife income doesn't hit that $250,000 threshold, those folks are going to get that money back. On the other hand, if it turns out that combined with the spouse's earnings, they exceed that 250,000, they will just it will continue to trigger that 0.9%, and that gets reported on the W-2. Self-employed folks are going to end up reporting and paying that with their 1040. Now, if you had maybe two self-employed spouses, one of them earns money, one of them loses money, you might, even though one of them earned above the threshold, the losses from the other may offset that and may bring them back below the threshold. However, if you've got a highly compensated employee that triggers this and they get wages from a job, and then you have a spouse who's self-employed triggering losses, the losses from the self-employed can't offset the wages from the high earning employee. And that concludes Chapter 6.